Good afternoon, everyone. Firstly, I'm very happy the way the conference has been designed. The topics have been conceptualized, and very fine speakers across the India. I've noticed, and as Arunji said, we'll be seeing people from east, west, all the places. Uh, the topic is input tax credit, and everyone, when we talk about input tax credit, the word that comes is seamless input tax credit, seamless flow of the credits. These are the things that comes up. And one of the reason why GST has been welcomed and introduced is we will not have cascading effect. Right? This is what we've been saying. There will not be any cost. There is absolutely credit for everything, and not like erstwhile regime. So everything is GST. So it's not like VAT or SEN-VAT or etc. Everything is same. And once you have registration, you will get the benefit of it. And very importantly, it said that it is system driven, robust. So this topic, I choose to speak on what are the regulations at a couple of industries which have picked up speaking that. And Pankaj sir will be talking more from the constitutional and some provisions related thing. This is the word we always look at. GST means seamless flow of credit. But is this written somewhere in the act? Is it in the rules? Is it really the promise of the act that okay, it's a seamless flow of credit? So when I looked at, did some research, and where is this principle? Kahan se uthaye? At the introduction of the GST, wherever, in fact, even today you go to the GSTN website and the publication material, you will find these words that the purpose is to enable seamless flow of input tax credit across the states also. Earlier, like our CST was restricted, VAT was restricted to the state, but right now it was across the states. And the implementation is also sought to remove the anomalies. I've just picked exactly whatever was there in the published materials. And there are also various materials that have been published which talks about this. If I have to, again, this is on the statement of the objects picked from para 1.12, where they are saying that the reason why we are bringing it is we want to reduce the cost. Eventually, everyone was saying input tax credit is a seamless flow, which is the biggest benefit. Is this reality? I would say to some extent. Now, whenever we hear these words, they shouldn't be taken as such, right? If it is a seamless flow of credit, we should never had section 17 blocking some credits, right? We should also not have conditional credits. So the seamless flow of credit comes with its pinch of salt. So there are certain credits which will flow, certain credits which will not flow. So seamless flow of credit cannot be treated as a slogan that every purchase that you make for the business, you will be having the credit, right? So there are instances where I'm not picking the basic the thing, but there have been listed instances where the credit definitely doesn't flow seamlessly. And to start with, the first and fundamental conditions that have been put in either when 16 subsection 2 or various things in 17, the flow doesn't happen seamlessly. In fact, though we say one nation, one tax, but since it is the state allocations is required, even between the states we have distinct person concept. I have a credit in one state, I definitely cannot use it in other state too. So I have to find a mechanism to cross charge ISD, and it should also fit into the true spirit. So there is again some blockages that happen. When I make a purchase, can I take the credit? I also have to fulfill that supply is in installments or payment to the supplier. So the new rule 37, 37A or section 38, all these are actually putting various barriers. Earlier, the movement of goods was at the state checkposts, which have been lifted. Likewise, now, just because the credit is there, it doesn't mean that the credit you will get it. So this is one first principle of the GST. I'll not get into the detail on the principles, I will just give highlights. The second thing which also we talk about whenever it comes to the GST is credit is like your vested right. which means once you have the credit, so no one can take your credit away. This also had been put to various judgments. One of the recent Supreme Court judgment, which is on Mohit Minerals, though it is in the favor of the SEC, but if you read the various observations made by the justice and all those points, technically it is like one suspense movie. Till the end, you will never find that okay, the judgment is in favor of the SEC. Finally, at the last, because of maybe dual taxation where the customs has been discharged, they have allowed the credit. But on all the places, they have said that the arguments taken by the revenue were also true. Likewise, we said credit, if the credit has come to you, it means it is your credit, it is a vested right. Some of the earlier judgments of the Supreme Court, they have said once the credit is you has been given to you, it's in lying in your electronic credit ledger, that means no one can touch. But today that's also not the fact. You cannot say just because you have a credit in your electronic credit ledger, eternally you have ownership on it. It will lapse sometimes, it will have various issues. Let's look at what will happen. Again, the utilization is also restricted. It's not that you have balance in one ledger, you can use it other ledger. Look at the definition of input tax credit. It talks about all credits, CGST, SGST, IGST. But when it comes to the utilization, it starts saying that CGST credit is different from SGST credit. So there are restrictions. And in one of the judgment, the courts also said, the where did it is not there, as like Arun sir mentioned in section 38, even though the credit is visible in your 2A, 2B, if you are buying from a new supplier, if the supplier has paid, they have given 6 different instances, you will not get the credit. Transition credits, I forgot to file the return, that is kind of lost. It was a credit earlier regime in VAT or excise, but since I didn't file, it was like lost. It had to be gone. It had to go through a long battle to reinstate. Again, 20/2018, all the textile people would be much aware that suddenly one night one notification came which says that whatever the credit lying in your credit ledger will be lapsed, right? So the arguments that have been made by the revenue, and these were also upheld in some of the matters, is ITC is a concession and not a vested right, which means the ITC that is there in your credit ledger, it will be again subject to some matters for utilization. So this is also another area where you have to take with the pinch of salt. One, whether it is a seamless flow. Second, the moment you have a balance in your ledger that you can eternally use it. These are the two things, is like it is a theory, but it is not an absolute truth. These are the two things I want to bring. Just to touch upon 20/2018, where the textile industry, where the inverted duty was not allowed, and when they brought into the mechanism of giving a refund, they passed this notification and said whatever the input tax credit lying in unutilized as on the date, the notified date, which is 31st July 2018, because from 1st August the input tax accumulated refund can be claimed. So whatever the balance that is there on that date shall lapse. Now this has come up suddenly, so which means they have to write off the balance which is there as on that date. So this is also again suddenly, which also justifies that point, that it is a concession given and a conditional balance. There are various conditions one has to fulfill to ensure that they get the credit. First and foremost, he has to be registered, and he has to ensure that he is utilizing in the manner which has been specified and it is used only in the business. He also has to ensure that all the conditions they have listed have been fulfilled. So just because I made a purchase, I made a payment, I will not get the credit seamlessly. I also have to satisfy next set of conditions that have been listed. Even after satisfying the conditions, the credit is visible. Still there is, of course, this section is not notified yet, but once this is again notified, it is notified, the procedures have not been laid down. Once it is laid down, this is definitely going to create a huge challenge. This brings to another point which I want to mention is GST is going to become a technology driven law. If one doesn't adopt the technology well or use the technology, they are going to be really at loss, right? So here it says that okay, if you are buying from a newly registered customer, they may set some quantum, but you will not get the credit. In fact, at the time of conception itself, they said that they will classify the suppliers or the taxpayers into red, amber, green and give some rating so that you know, you are aware from whom you are buying. So somewhere you are also being brought to restriction on the business. Now again, as a law students, you will start talking about, okay, isn't it violation of Article 14, 19? But still, if you have to notice that it is not the whatever which is written on the paper, that it's a seamless flow of the credit. If you are buying goods from a supplier who has paid lower tax, now he has filed return, but he has paid lower tax. You don't even have a visibility what's happening, what is the other employee in the organization doing, but now you are expected to go beyond. You are expected to look at the supplier side, what he is doing, and ensure your compliance is better. Now these are the one which are going to be very challenging, right? Now in midst of these challenges, let's look at, yeah, again one other basic condition is if it is only towards taxable supplies, you will get the credit, otherwise you don't get the credit. So let's start looking at the industry specific, what are the additional things that are available. So I'll pick one by one, starting with the restaurant industry. Very simple, straightforward. The rate of tax is 5%. Now, unfortunately, even the composition scheme rate of tax for them is also 5%. Every place I have been mentioning HSN, I'll touch upon whenever it is required. And in the earlier session, we have realized how important the classification is. With the change in the classification, the conditions, the rates would change. Now, I brought the restaurant because that's simple to start with. The restaurants at 5%, since it is an abated rate of tax, generally services are 18%, so the rate of tax has been abated to say 5%. Now, can I get the full credit? The moment it is abated, the rate of tax is lower, your credits have come to restriction. So your seamless flow and 100% utilization of the credits started dent by with whenever there is a tweak in the rate of tax, something changes. So if you notice, the credit of input tax credit on goods and services used in supplying this service has not been utilized. That means they cannot use the input tax credit. The moment they cannot use the input tax credit, so all the purchases, it has become the cost. The tax on this, it has become the cost. Eventually, the rate of tax is not 5%, because this cost which has been there, it is loaded back onto the product, and the product at 5%, the rate of tax effective, what is visible is 5%, but the effective rate of tax, the money which that will be collected will be going up. And these amounts will be subjected to common credit. So if they have again another line of business, even this entire turnover will be subjected to reduction of the common credits. So there is a burden on the input tax credit movement industry to industry. Next one, very important, is the real estate. Now, real estate, for some reasons, the department had this issue that, or the public had this issue saying that okay, my builder is collecting taxes, maybe whether he's paying it or not, or a sentimental feeling, I'm buying a home. For that matter, even not home, if you are saying that okay, like you are going out and buying a phone, and if the shopkeeper says okay, it's 10,000 rupees plus 18%, 1,800 GST, back of the mind, the consumer feels that the value of the phone is only 10,000. Rest additional whatever he is paying is like it doesn't attribute to the value of the phone, is like it is going to the nation building. And higher the rates of taxes that comes in, then it also starts creating the parallel economy. So that is where there is also, economists always feel that the 18% and above should never be crossed, because it will push the parallel economy coming in. Now what happened with the real estate? the rate of tax has been brought to 5% and 1%, though it is 7.5 and 1.5, but for a common man understanding, they said that we will bring the rate of tax to 5% and 1%, and they brought in is affordable housing, which is less than 45 lakhs, and other than affordable housing. But what they have done is, if it is a residential project, RREP, residential real estate project, they said do not avail the credit. So again, this 5% and 1% or 7.5% and 1.5% is theoretically a myth, because whatever the procurements they do, the procurements also suffer GST. Not just that, they are not saying that the credit is restricted, they are further saying that additional credits, I'll just come back to this slide in a while, but they are also saying that you pay whatever the liability that you have, pay it only in cash. So even if you have 2-3 businesses, you have credit in one business, you cannot use that credit in this business. Again, there is a dent, like assuming if I have construction segment and I also deal with, let's say, steel, iron and everything. So I have a trading segment, I have a construction segment. Both are under single PAN, single GST, and everything under, say, proprietor, one entity. Still the credit which is lying here, the credit cannot be used. I am not talking two different GSTians or two different distinct persons, but it is single person, still the credit has been restricted to be used. And these purchases do suffer GST. The condition is you should not avail the input tax credit. I'll also ensure that you do not create a parallel economy. Whatever the procurements that you are doing, up to 80% at least has to be from registered persons. If you are procuring from an unregistered person, then you will have to pay the taxes again from your hand. So there has been definitely the earlier regime, if someone builder does a calculation, the rate of tax, there is no change. Earlier, which was at 12% to vis-a-vis a 5% now, technically there is no change. It's just that the end customer feels that he is paying lower. The 5% is kind of an experience to the how it is packaged and marketed, is what I would say. The one other thing this industry has a challenge is this one complicated formula. In fact, whole of the GST, the notification 3/2019, which itself could be like a book by itself, it's a almost 50-page notification. Just to read and understand, if you look at that last formula, TR is equal to T multiplied by F1, F2, F3, F4, all different formula racing. What a human mind commonly can understand is, you give, say, 50 multiplied by 40%, you can understand. Multiply that by 35%, multiply by that by 25%. You actually do not know what you are aiming at, what you are resulting into. Of course, this is well thought, beautifully drafted, but one complicated math one has to undergo to ensure if he has to switch, he has no choice. If it is a project which is about to complete, he would rather switch, because he want to sell his inventory showing 5% is the rate of tax, and he has to undergo this complicated math to find out how much input tax credit he has to reverse. And the concept of maintaining books of accounts project wise was not there till this point, but suddenly on 31st March 2019, the law comes in saying that you now segregate all the credits starting from July 17 to date project wise. When you look at section 35 read with rule 56, you never have this bifurcation expecting the input tax credit to be segregated project wise. But now that has moved into that, okay, you segregate into project wise. In fact, at least I would say 70 to 80% of the professionals practicing in GST, they struggle understanding what they intend to give this formula T multiplied F1, F2, F3, F4, and all these are percentages. You can see as the flow down happening, some 25%, 70%, 60%. I've just simplified it the way to understand it, but you are multiplying one value with 4 different percentage without even knowing what you are ending up. This is how another complication that has been brought into this industry. Then the next thing this industry also is facing is payment of taxes on the development rate, which itself is subject matter of question, but kind of after a long battle, everyone settled and said that okay, maybe development rate taxes is there. Unless otherwise, we wait to hear some of the matters which can go, and of course, there is nothing in the Supreme Court pending to discuss on this matter. But a lot of high courts, there are writs pending on this matter. Eventually, government is taxing one or the other way. So, on one hand, I do not have input tax credit, 5% lower the input tax credit. Now, the concept of development rate has been brought in. So, if you ask the landowner to pay, he would say, I am selling the land, so you will not pay. So, indirectly, they brought it into the developer. So, developer is now paying a tax which is a reverse charge basis. Now, when you see again the objects when the reverse charge or even in the service tax era, wherever the arguments were taken, even the from the revenue side, it is always revenue neutral. So, you are paying the tax and claiming the credit. You are paying the tax and claiming the credit, hence there is no loss. But however, again this industry, they will be paying the tax, but they will not be claiming the credit. This is another challenge that this industry has to be very mindful of. So, 80% they have restricted to certain input services, and anything difference you pay it under RCM. For cement, they said you pay it every month, and other than cement you pay once in a year till the project is complete. Once in a year, pay it by June. This is the another condition. Cement on a monthly basis. And they said whatever you are paying, whatever the tax you are computing and paying, pardon me for a lot of formulas or things that are coming up on the thing, but whatever the thing that you are paying, you also got to ensure that the attribution to all the units have been done. So, the development right taxation is included or extended to the units which are not been sold also. If I have to simplify and say one single way of example, if a builder is building some 100 units and some portion is going to landowner, some portion is going to the owner, he will end up paying tax on everything one or the other way, whether it is a reverse charge, whether forward charge, and importantly, no input tax credit. The business GST is input tax credit. Here you have additional levies that are coming up, but no input tax credit. So, real estate industry for ITC, they can only say one word, that it is only a liability and no ITC for that sector. And it is also blocked. Whomsoever is buying 17.5 and 5 subsection C and D, whomsoever is buying, even for them, if they are constructing a factory, even for them there is no input tax credit. So, this sector, and this is one other growing sector, 7% of the India GDP directly indirectly attributed through this sector, and where the government makes money at the final consumer. So, whatever the steel, cement is produced eventually goes into the building and which goes as a blocked credit. So, at a point in time, all this chain in the industry gets added back as a benefit, and I will not say unjust enrichment, that is a law that has been passed. So, one needs to be mindful that okay, this industry you do not have input tax credit. Next, chit fund industry, the foreman commission. So, even this there has been a change. So, July 22, again some list of notifications that came in the month of July. One of this was this. So, where on the foreman commission they were paying 12% rate of tax, but here when it was 12% rate of tax, they said that okay, you do not take the credit for goods, take the credit for services. That means the conditions are now, there is a goods separate and the services separate. Transportation, passenger transportation, here the condition is okay, you do not take the credit of goods and services. The restriction is do not take goods and services, but if you are taking it from same line of service provider, if you are taking the credit from same line of service provider, then take the credit. So, you have to now identify the purchases, how many are from the same line of service provider. How do I identify same line of service provider? Like every slide you have that like HSN, some 9964. Now, you need to identify the purchase bills that are coming, whether it is in the same line of service provider or not. The issues comes up is, if someone is a tour operator and he is entering an HSN as 9985, versus 9964. What will happen to those credits? So that is another challenge this industry has to be taking care. Passenger transportation, earlier we have seen the roadways, but when it comes to the ropeway, here you will not find the condition for service. So they get an input tax credit for services, but they don't get the input tax credit for goods. That means every industry also have to look at the conditions that have been attached. So one, we said it's not seamless, but at the same time the conditions are not that simple as we look at it. GTA, this has been a litigation going on. We know, okay, mostly everything, early everyone adopted, okay, fully reverse charge, I don't need to do anything. Then later, as the time passes, okay, you want to be taking ITC, raise 12% and take. Then a recent entry, raise 5%, do nothing. As much confusion as you can, you got it. What is specific or careful about this industry is, since they are also in RCM, it means as good as an exempt supply, they cannot avail any input tax credits. So the industry also have to, you will have to see which entry you would want to fit in, whether you want to take the credit, not take the credit. Again, this is the credit definitions is also not unique industry specific. Tour operator service. One challenge with this industry is, firstly, they cannot take any credit, same like the passengers that we see, other than people in the same line of business. If you are a tour operator service, then you can do it. But the condition they have is you raise invoice 5% on the gross value. All right, that is what they have done. Now the challenge this industry they have is, technically the definition of tour operation is planning for accommodation, travel, various things. Now the planning can include maybe some aspects of the tour you might plan, some aspect of the tour. Today they would want to do booking, some booking themselves and some booking they want your assistant. So when someone is doing partially some aspects of it, again when you look at the definition, package usually includes buying and selling of baggage, accommodation and everything. So the tour operators now facing this issue if they do only accommodation booking. It's like they will assist you, look accommodation at a place where you want and they are doing. Now can they also become a provider of an accommodation service? Can they say that, okay, I'm providing an accommodation service and not tour operation service? If they say tour operation services, HSN is different, accommodation services, HSN is different. Conditions to avail is different. It is like both the two different industries, right? Or I only do travel arrangement, he did his booking online through Make My Trip, etc., but he wants me to help through do local sightseeing and other things. So as earlier session we looked at parts of the engine versus engine, they fall into two different charts. Now parts of the tour operation services I am doing some part of the tour operation services, will I still be a tour operator? If I be a tour operator, the conditions are different. If I am not, the conditions are different. So every industry, the input tax credit is not a straight answer, that is what you are availing. Hospitality, hospital health industry. Like Arun sir said, it is a composite supply, 5,000 rupees, why ICU additional, in fact that needs to be tested. But this industry, they said, all the medical consumptions which are happening, everything, no input tax credit, which means no input tax credit on medicines used, on the capex. In fact, this is a very capital intensive industry. On the capex, no input tax credit. So the input tax credit is restricted. The moment, the points that you have to look at it, just because you have been given an exemption, is it a beneficial? May not be. Like Metro Corporation, Metro Rail has been exempted from say taxation, but all the procurements they are doing it. It is like at what point they will be profitable, they don't know. Added to that, all the procurements are cost, it will be into like losses. If there is an abated rate given, should you celebrate? Because the abated rate comes with the conditions, do not avail credits or avail only the partially. So these are the other things, that you need to be very much mindful of. The point which I want to drive is input tax credit. It is good to hear seamless input tax credit and a simple, every buyer who is into business, you get credit, and once the credit is taken, it is for you. The answer to it, it is not a conditional yes, it is not an absolute yes, it is a conditional thing. and the definition of the credit would also change from industry to industry. So we got to definitely be practitioners of the GST, very mindful of this, and when we advise to the clients. So on this note, I end my session, and there are other points which I request the other speaker to constitutional aspects of it to touch upon it. Thank you very much.